Well,
Okay.
hello everyone, and welcome back to Risk. Today we have a author of the Great Silver Bull, Mr. Peter Krauth. It's great to see you again, Peter, and I'm really excited for this discussion because I've delved into your book. I have not yet completed it, but I've been enjoying it. There's just so much in there. It must have taken you some time and quite a bit of research to get this done. So how have
You're
you been?
so Lee. Thanks for having me. It's a pleasure to be with you on this show. And you're right. It is. Certainly has been a lot of work. I started over a year ago, and we're about ready to launch. So it's really exciting, and I think that it's an asset that investors really have to take a very close look at. It's not perfect, no asset is, but given the kind of economic environment that we're dealing with and that we're looking towards, I think that this is a must-own asset.
You know, what I found interesting about your book is you go way back in history with silver and you cover so much from basically the dawn of civilization. And I think this is a really important message for anyone who is investing. You can't live in the here and now. You can't live with the normalcy bias. And people have been doing so for decades now, especially in the United States and in the West. Your book makes some really good historical references and points. You know, the devaluation of currency back in the Roman Empire and so on. I mean, having studied all that history, is there anything you've learned or you think that's pertinent or important for viewers to know?
Yes, everything in the book. You talk about normalcy bias, and I completely agree. There's also recency bias, and I think that's a very big mistake. I think a lot of your viewers probably know Ray Dalio, and he alludes to a lot of that. And he even said recently, cash is not a safe asset because it will be taxed by inflation. Um, and yes, you go back over history, and I think this is a very key thing for people to note. Gold and silver are the only assets with a multi millennium proven history of being liquid assets that do not have counterparty risk, and in especially times of inflation, as I think is going to be a defining feature of this decade. They really need to own gold and silver. And silver, I'm a little bit biased. It outperforms gold in bull markets. And so, yes, it's more volatile, and we can get into that a little bit more. But silver is a must-own asset for those reasons. And you talk about history a little bit, 5,000 years, and I talk about silver's history going back that far as money. And I also talk about interest rates. And there's a very difficult book to get through called The History of Interest Rates, but I actually read it, and we're at
That
5,000
that
years.
that, that sounds like fantastic vacation reading.
Exactly. But I know the importance of it, and it actually wasn't. It's not an easy book to get. It's not an inexpensive book either. But given the work that I do, I bought that years ago and read it, and we're actually at 5,000 year lows of history and interest rates. And what the author of the book, I guess, concludes is that after long periods, because we've gone through this sort of thing. It's never been this low for this long, but we have been through long periods of low rates, and that's when you have empires basically that are mature and peaking. And when rates have been low for a long time, and those empires are peaking, what they start to decline. And as they decline, interest rates start to rise, and they start to rise dramatically. And so, central bank controlled interest rates may stay low. In other words, short-term rates. They may try doing things like yield curve control and all of this sort of thing. Nonsense, I guess, in fact, you could say. But there's going to be a point where they lose control, and especially longer term rates. We've seen that already this year. 10-year, 30-year. there's the IEF ETF that actually tracks treasuries that are 7 to 10 years out, and that's down 10%, while gold and silver are up 10%. So far in 2020, gold and silver are outperforming bonds by 20%.
Traditionally bonds have been their interest rate has always been commensurate with the risk that you're undertaking for purchasing that bond.
That's right.
And we are very much in a synthetic market that is controlled by, central planners at the Federal Reserve and world banks. So I think that is something everyone must consider, especially with the 5,000-year low in rates.
That's right. Exactly. I mean, the 60 bond, 40 stock portfolio is dead, and it's been great for 40 years. Both of those have gone up for 40 years, but that's way longer than your average bull market in both of those assets. And so we talked about this at the very beginning, recency bias and normalcy bias. People need to be very careful about this. And I think that seeing bonds, which, investors that maybe spend less time looking at these sorts of things than perhaps you and I do, depend on bonds in their portfolios, and they've been told by their portfolio advisors that this is the way to go. If they're looking at their statements and they see their bond funds are down 10% in 3 or 4 months, I think that they're gonna be shocked by that. Bonds are supposed to be safe. Bonds are supposed to be, a lot more stable than stocks. But they go through, years and decades of cycles, and we're bottoming right now in bonds in terms of yields. They've been rising dramatically, and that's why bond prices have been falling. And we would need to look at alternatives, what's performing, what performs in this kind of environment. And there's no question that silver is a standout asset. The subtitle of the book is "Crush Inflation and Profit as the Dollar Dies." Silver has proven itself as an inflation crusher. If you just look back to the 70s, gold was up, was it 1,400%? Silver was up 3,700% in that decade. So it more than doubled the return of gold, and that's just silver itself. It does not even look at what silver stocks did. So it's definitely got its place in everyone's portfolio.
Two of the messages I got from the book, which I obviously agree with. One is all central planned currencies, fiat currencies, eventually fail. And when they do, precious metals are usually the savior to those people holding them. And now I forgot what the second point was. I'm sorry.
That's all right. It'll come back to you. That's no worries, for sure. But yeah, I mean, if we talk about the 70s, that's the best analog that we have. And, inflation hit 15%, mortgages hit 18%, and the Fed raised rates to 20%. There's a big difference, though. I mean, as much as it is an analog, one of the things that I point out about that period in the book is that the debt to GDP was 35%. That meant that if you had to raise rates because inflation was high, and that's what central planners should be doing, as much as I think it's all a mistake to be trying to plan an economy. The Fed was able to do that back then because debt was relatively low. Exactly. Yeah, today we're at 130% debt to GDP. So on a federal level, debt is high. On a personal and on a business level, debt is historically high. So as much as the right thing to be doing is to raise rates to help control inflation, I mean, there's only so much that central planning can do in terms of raising rates. It'll make the debt practically impossible to service in terms of interest payments. It'll crush housing, all the sectors that are related to housing, renovation, furniture, you name it. It just goes on and on. There's energy. It's a real domino effect. And so what I take from that is that central planners' inability, because frankly they will be unable to raise rates sufficiently, means that they will not be able to get inflation under control. they'll have to let it run because they will not be able to do enough. And that will be kind of, I guess, the lesser of the two evils of raising rates enough, crushing the economy, or backing off, letting inflation fly, and making the debt easier to pay back, but hurting everybody else in the meantime.
Well, I think we always say inflation, but I really don't think that's the appropriate term. I think it's really just currency devaluation that we're experiencing and have been for decades. Would you
You're
agree
right.
with that?
You're
Yeah.
absolutely, because the definition of inflation is an increase in the money supply. It's not technically an increase in prices. It's an increase in the money supply that leads to, the increase in prices that we, commonly know as inflation, is a symptom, but the
Mhm.
actual cause is an increase in the money supply. And so, that is something I talk about in the book, that that's been the case since we're off of the gold standard since 1971, Nixon closing the gold window. But it really kicked into high gear with the financial crisis of 2008, 2009. And, money printing just went off the charts. And yet, speaking of charts, I've got a chart in there where I show the bump up in Fed assets in 2008, 2009.
So,
We
one of
had,
the points that you made in the book was the supply of silver versus the supply of gold. And I
right.
found it very interesting how drastic the difference was. And in my head, I'm thinking, why is silver so inexpensive compared to gold? If there's much less of it and it is being used every year in, industrial and other uses, why is it less than gold?
You're right. I mean, proportionally, it should not be as cheap as it is. Really think the jury is out in terms of the reasoning. There are all kinds of conspiracy theories that keep, circling that whole thing. It's possible that to some extent, there are supplies that are being drawn down. It's hard to really know what recycling is every year. It's very difficult to get proper numbers because that's something that's actually estimated. As far as I know, the Silver Institute has to estimate that number. And so, it's just a combination of things, but I think that it's, we're going to see a period like we saw in the late 70s where, silver is going to kind of come into its own. Gold will run first, as it always does in bull markets. People will see that happen. They will say, "Oh, I've missed that boat. What can I do now?" They'll look at the next logical alternative, which is silver, which is considered, the poor man's gold, so to speak. And so they'll see that it's much cheaper on an ounce per ounce basis. That will drive silver, and especially in the later stages of a precious metals bull market, and that's typically why it tends to outperform gold. In fact, even dramatically.
So you have a pretty substantial portion of the book dedicated to risk and risk management. So why don't we touch on that? I know you have a lot of like traditional risk management techniques in there, which everyone should be familiar with, such as sliding stops and et cetera. Now you apply those mostly to your portfolio of equities, or do you also hold physical silver and gold and apply them equally?
Yeah. So here's how I feel is the best way to go about it. The physical is not something that I would apply trailing stops to. If anything, if anyone owns physical and they feel like they don't have enough, I suggest that they buy when they see weakness and add to it that way. But these other methods in terms of controlling risk, what I do, and that those are especially applied to the equities. First, if we talk about, say, ETFs, which are, let's say, those along with maybe some of the large producers and royalty companies are going to be the lowest risk. Naturally, larger market caps, the silver equity ETFs are sort of instantly diversified. So those are the kinds of things that I would buy and potentially hold for, the length of the bull. I'm not saying never sell during the bull. I am saying that if I would sell if I saw that a larger producer, for example, I felt was not performing, or maybe some management issues. There could be all sorts of things going wrong, for example. And sure, you could sell, you could also take profits. That's definitely something that I recommend in terms of playing with the house's money. If a stock doubles, you'd want to potentially sell half. But the larger plays, I, for the most part, tend to want to buy and hold for the length of the bull. When it comes to some sort of mid tiers and juniors, that's where I certainly want to be more cautious. Definitely sell on a double, sell half on a double, use trailing stops, perhaps on a yearly basis, do some rebalancing, take profits and shunt those profits into either some of the ones that the assets you may own that you feel are undervalued, or things you've been watching that you like to get into, and you can, sort of reallocate some of those profits to some of the stocks that you have been having an eye on, so to speak.
So I'm trying to think of there's so much in that book. Why don't we talk a little bit about your approach to mining stocks and how you select them? You've been at this for some time. You have some pretty deep connections and knowledge in this space, and it's very confusing, I think, to most people. You do have the juniors and you have the majors, and very few equity plays or pure silver equity plays. Why don't you give us kind of a broad overview of investing in that space, how to mitigate your risk beyond what we just talked about, and how to pick ones and sort through because there's really there's a lot of bad equities out there when it comes to precious metals as well.
Absolutely. So, I mean, I have a few filters in terms of the kinds of companies I'm willing to look at and invest in and recommend. One of the first things is going to be jurisdiction. That is a moving target because those, I feel the risks change over time. And so, nothing stops you from selling a stock if you feel that risk has increased in a specific jurisdiction. But that's one filter. Another filter is management. And another filter is the exposure to silver, because you're right, it's difficult to find really what you would call silver stocks, and believe it or not. One of the reasons is because, and I do talk about this in the book, is that silver has what I call a quirky supply profile. Only 25% of silver comes from primary silver mines. The other 75% of silver comes from mining other metals. So things like gold, copper, lead, and zinc. So a lot of silver that's produced, even some of the largest silver producers are not primary silver producers. They just happen to produce a lot of other metals and therefore a lot of silver. But what's interesting is those companies do not treat the silver as that relevant to their revenue streams. And so even if silver prices are high or relatively high, they are happy to accept higher prices for silver, but don't really react otherwise. They kind of accept that and keep producing their other metals. And so what tends to happen is that, and even for primary silver producers, they want and need to see silver at elevated levels, the price having risen and stayed elevated, sometimes for as much as a couple of years before they're willing to say, okay, I'm going to start mining differently. I'm going to start looking at bringing some of my projects into production. And so you've got this delay that, of course, exacerbates the supply, that allows the price to continue rising. And here's an interesting example. Let's say a company does mine a fair bit of silver. They may decide that when they see the price has risen, they may decide, oh, well, at this point, because silver's, let's say, at $30 or $35 rather than $25, now my lower grade ore is actually more valuable than it used to be. And so I'm going to because I can mine profitably a lower grade ore, now I'm going to go into this area of my deposit and mine this lower grade ore, and still make a decent profit. But what that does is it may actually lower their output of silver. And they don't really care. I mean, they do to some extent, but they're looking at their bottom line, which is profit. And if their profit is still acceptable, they're happy with that. But yet the silver supply suffers. And so that's an interesting sort of way things play out. So what I just want to get back to one point that I started on earlier is that one of my filters being how much silver either a producing company or an explorer has. And so my filter is that I look for at least 40%, preferably 50% of revenues if a company wants to be considered a silver miner, so revenues from silver. And if a company's a silver explorer, then again, I look for ideally at least 40 to 50% silver content on their flagship asset if they are a silver explorer.
So you've kind of broached political risk here in your last example. Let's broaden that out a little bit. Let's talk about the history of political risk in the United States for investing in actually silver and gold. And at one point it was illegal to own these things. I mean, do you
That's
foresee
right.
that happening again here or in other countries?
Uh, you know, that's obviously a big tough question. We're trying to forecast and see what may happen. I'm going to say it's a very different environment from let's say 1933 when gold was confiscated, silver was confiscated, by the way, too.
Yeah, I know.
Which
I read that section in your book. It was great.
exactly. And so the environment's different in the sense that gold was actually money back then. It was used in day-to-day transactions. You had loans that were priced in gold. And so because gold it has so little impact in terms of daily transactions and actual money, I really see the risk of that being very low. I don't see, it's so under-owned. In fact, compared to back then, I don't see, really governments caring that much at this point. So in that sense, I think the risk is actually quite low.
One of the flip side of that is that because it is so under owned, that when the panic comes, it's going to be crazy. But also to add to that, I think one of the clear messages in your book is that silver and gold always reassert themselves as money eventually, just because it's just their natural thing. That's what they are.
This is right. Exactly. They are natural chaos, uncertainty hedges, and they always have value. Silver in particular always has value and utility because it is so useful in so many industrial applications. 10% of all silver consumption every year goes to one application, and that is solar panels. And we're pushing so much towards a green economy and green energy that's just going to, in my opinion, keep pushing up the floor under silver prices. That is really impressive to think that one application uses 10% of all silver, and 50% of all silver is industrial use. So that certainly makes silver somewhat different from gold, its utility. And in medicine, it's a biocide. So you really see almost daily new applications for the metal, and it's got its place in a modern economy. Electronics, I mean, it's really everywhere. Automotive, you name it. It's really it's ubiquitous. It really is.
You keep referencing the 70s, and during that time there was a big commodities boom, and I think you'd make the argument that that's where we're at in the economic cycle, and silver is just a part of that. But you also see other things booming as well, correct?
I do. I mean, commodities in general, I think that we're in a super cycle for commodities. I think that would have started whether, COVID came along or not. I think it just accelerated everything because it just took the money printing up an order of magnitude. And so it's just brought us there much more quickly. And I think it's made this cycle, as I say, an order of magnitude probably bigger than it typically would have been. So it's going to have its ups and downs. This is a show about risk. This super cycle is going to have its ups and downs. In fact, I have charts that reference that in the book, but in the 1970s, this is an interesting research by Crescat Capital, and they showed that, inflation didn't just rise, or prices didn't just rise, and then stay high or kind of keep rising. What happened is they rose in 3 separate waves. Each wave was successively higher. So typically, what I take from that is that, so you had this inflation, you had central banks kicking in, raising rates, trying to quash that somewhat, seeing how it was hurting the economy, backing off, letting that ride for a while, seeing prices rise again, they'd come back, do the same thing. So you had this 3 times during that 10-year period. And so it's not a smooth ride. And so you do have to expect these waves. So you would have commodities in general probably rising, dipping, rising again. But the overall trend is going to be higher. And I feel probably, we're looking at anywhere from easily 5, 6 to maybe 10 years, perhaps even longer. These cycles tend to play out over quite long periods.
Well, look at the equity cycle we've had. It's been since 1980.
That's right. Exactly. That's a historical length for an equity and bond bull market.
So how do you think the supply chain issues that we're facing globally, which in my opinion are going to get worse as time goes on, how do you think that's going to play into the demand for silver, especially since you just alluded to the solar panels being 10% usage of silver every year? I mean, if we continue to have supply chain issues, and I think there are current issues impacting that particular marketplace, how will that affect the demand of silver?
Yeah, there really are 2 sides to it for sure, because if production of certain things fall off, then you could have some dampening of demand for silver, for example. But there is just so much pressure, I think, from governments that we've seen, and it's funny how things kind of fall away from memory, but I remember very clearly because I had started writing the book, and goes back to about sort of the first half of 2021, and I was getting going, and there was and it's still there. There's no question about it, but you saw and you felt the sense of how governments were really pushing, as they talked about stimulus, they were really pushing this new green economy. And it's something that, constituents, voters are very much on board with. And so I think that because that trend is just so powerful, I see an ongoing, considerable strength in demand for silver, given its impact and its necessity in that entire space.
That does make sense. Is there anything from the book that you'd like to cover, or anything in current events that you'd like to cover that we have not spoken about?
Yeah, we talked about there are some really big changes that I see coming. One of the things I talk about in there is how we're starting to see this more and more, but how there's this I think inevitable trend towards central bank digital currencies. To me, that's very scary.
Yeah, no, I agree with you, and you do a fair amount of coverage on CBDCs as well as just cryptos in general.
Exactly. And there is a relationship, as far as I'm concerned, to silver. But what I find scary is that, there was something reported not all that long ago, how, the Bank of England is instructing or directing members of parliament in England that they should make sure that any central bank digital currency in the UK be what they call programmable. So that would mean that the government could decide from one day to the next, well, this is our new form of money, and we think it's okay to spend it on these things, but it's not okay to spend it on those things. That, who knows what that might mean? That might mean groceries and necessities are okay, but donations here or things that are considered luxuries, for example, are not okay. Who's to say?
Right. Yep.
That to me is very scary in terms of that, government having that kind of ability. What I find really interesting is that there has been a big push towards, especially in the US, towards removing things like taxes on gold and silver. And early this year, Idaho actually passed what they call House Bill 52022, and it's the Idaho Sound Money Reserves Act. And so that's supported by the Sound Money Defense League in the US. And so it's past the House level. It needs to, be introduced, and it would eventually have to pass Senate, but it's actually pretty groundbreaking. What it does is it would permit the state treasurer to hold some portion of state funds in physical gold and silver. And their view is that that's to help protect against the risks of inflation and, things like financial turmoil,
Sure, yeah.
and to achieve capital gains against measured in Federal Reserve notes. And so if I remember the numbers correctly, Idaho has about 10 billion in its treasury, and most of it is in bonds. So if you figure that inflation is at least 5 to say 7% officially, that means Idaho's losing about $500 million a year in terms of purchasing power on its cash. And I actually, that kind of leads into another point. Last year, again, as I was kind of getting started on the book, and I had done some research, and I thought to myself, wow, let's look at what some of the big public corporations have in terms of cash. And if you look at the FANG stocks, just those 5 largest FANG stocks at the time, I went and looked at their cash positions, added them up, and we were at $500 billion of cash. Wow. So $500 billion of cash, just those 5 companies.
Right. And then losing 5% of that every year, that's a significant amount.
Exactly. Yeah. And so the next thing I thought was, well, hang on a sec. If that goes on for a while, shareholders are going to clue in, and they could very well at one point say, well, hey, you need to do something with that cash. You can't just let that cash lose purchasing power. You need to either buy assets that are going to be accretive, or you need to take that cash and put it into some kind of other asset that's going to protect purchasing power, because technically that's a loss for shareholders. So it really impressed me that around that time, I think what triggered it was, I remember that Musk over at Tesla had changed the investment policy of Tesla.
Yeah, this was right around the time Michael Saylor did his corporate, and he was pushing corporations to get into Bitcoin.
Exactly. Yeah. So Tesla bought Bitcoin, but they shortly after that changed their investment policy to say that they would allow themselves for cash that was excess cash that they didn't need to operate the business, they'd be allowed to take that excess cash and put it into, and they specifically said things like gold related assets, ETFs, etc. And so I thought that's kind of what triggered the whole thing for me. And that's when I looked at the cash positions of these large companies. And I said, it would not surprise me that at a certain point that shareholders could look at this and say, wow, well, you've let this cash position sit there for 3 years, 4 years, 5 years. We're down 20, 30% on just the cash. This is tens or hundreds of billions of dollars worth if you spread it across these companies. And perhaps even start litigation saying, or at least to put pressure, right? Say, you need to do something about this. You cannot just let this sit like that. That's ridiculous. And we saw that, I think it was, forget the name of the company, but starts with a P. It's a software company. And they, about a year ago, did They did something along those lines, and they bought a whole bunch of physical gold and kept it in storage, and that was as a hedge against uncertainty and chaos. They just took a chunk of their cash and said, "We're going to do that," and yeah, that certainly starts to set the bar for sure.
You know, one of the things we kind of touched on in this discussion, but really didn't go into, gold and silver and precious metals are kind of the complete antithesis of central bank digital currency. While central bank digital currency is the ultimate dream for economic central planners who just have to control everything, precious metals are the complete opposite. They take all control away from them and put it into the hands of the individuals. Would you agree with that?
I would totally agree with that, and that's why it's interesting that they, despite that, continue to own plenty of gold, right? So
Because they know their history. That's why.
right. So it's my sort of answer to that is look at what they do, not what they say.
Yeah.
And if they continue to own gold and they continue to repatriate their gold, in fact, that's definitely what you want to look at and watch. And so, bringing in central bank digital currencies will exacerbate the problems of money printing, as far as I'm concerned. And the kind of the link, I mean, these things already exist, but you have gold and silver backed digital currencies. And if you look at the benefits, utilities of cryptocurrencies, there are plenty. There's no question. I don't think that you can realistically, deny that. And so my view is that we will likely get to a point where there's going to be a reset. And the ultimate answer, in my view, is that we're going to end up using a crypto or a digital currency that is backed by physical gold and silver. And that, to me, is sort of the ultimate answer, because again, you cannot deny the practicality of a cryptocurrency, sending money instantaneously, at almost, as we call it, frictionless transactions, next to no cost. And as long as it can be set up in a way where there's sufficient trust and comfort that the metals are there, I think that really is the ultimate answer to exchanging value for transactions.
I think what you just said is a high hurdle, though, getting that trust.
Agree, and that's why I pointed that out, because we need to get across that for sure.
No doubt about it. Well, Peter, thank you so much for your time. As expected, this was a great discussion, and I highly encourage anyone who's interested in precious metals, go out and get your book and read it. There's so much information in there. I was reliving a lot of the interviews I've had over the past year with people while I was reading it, and I'm like, oh yeah, they said that and they said that. So it was good.
I mean, I think I've done something kind of unique. I've obviously focused on silver, but I didn't want to just talk about, a specific aspect of it. And I really wanted to give the background. I wanted to give the explanation, and hopefully kept it in language that was easy enough for just about anyone interested in it to understand it. And then be practical in sort of the second half of it, and talk about how you can take this and apply it to yourself, and really benefit from silver and what it has to offer.
Well, I wish you luck and success with the book.
I really appreciate that. I just want to point out, if anybody wants to, have a look and keep track, the book, depending when this airs, should be available on Amazon. It's The Great Silver Bull. You can certainly get information anytime on it at thegreatsilverbull.com. I've actually got a copy of the cover of it right here. We're still
nice.
in the sort of few stages of getting this out, and so that's what it's going to look like. And I mean, I really appreciate the time, Lee. Risk, as we were saying, is a much too ignored and underappreciated aspect of investing, and silver is certainly something that, because of that, needs to be part of everyone's portfolios.
Yeah, and in my opinion, now silver is probably the least risky asset in the world.
I would have to agree. If you look at, and I do talk about that, it's so inexpensive compared to other metals and other assets, and to compare to its previous, inflation adjusted highs, that it's very difficult to find better value than silver, both in the metal itself and in the silver investments.